Well, if you've been watching the news lately, you might have heard the word tapering, especially as it relates to the Federal Reserve. And tapering is one of those words I think that was invented by economists to make everything sound more complicated than it is. Because what does tapering mean? Well, tapering means the word tapering something off. We're slowing it down to a stop. That is what the Federal Reserve is doing with their bond buying program. So take a step back. How does the Federal Reserve set interest rates? When you hear about interest rates going up or down, how does that happen? Well, it's not just a whiteboard that they write down what the interest rate is and everybody just kind of agrees to follow along with that. They actively change interest rates by infusing the economy with cash or taking cash out of the economy. How do they do that? They buy securities, specifically bonds, from the public at large. So they take money in their bank accounts and buy securities, a piece of paper. And so that adds money to the economy. The reverse happens when they sell securities and take money out of the economy. So when they're tapering, and when you hear that in the news lately, what they're really doing is they're slowing down the amount of securities that they're purchasing. What does that do? It slows down the infusion of cash into the economy. And in the long run, historically at least, it should raise interest rates if you slow that down or eventually stop it. Less money in the economy, the price of money, which is what an interest rate is, goes up. Simple supply and demand. So that's kind of a peek under the hood of how the Federal Reserve works. But when you hear the word tapering, just think of it as the Fed slowing down the amount of money they're pushing into the economy, with the end result of interest rates probably rising here in the next year or so.